Welcome back, Doug Burson here, and we're halfway through 2024. Hard to believe, but here we are. Actually, we're past halfway. We're at the end of July, almost into August. And so I thought I would take some time to talk about where you are on your taxes today. I think this is going to end up being a two-part series. We'll see how we do, but I'm probably going to do this in two parts. There's a lot here I'd like to cover and give you guys some things to think about. Because right now, there's still time to fix things if you've made some tax mistakes. We can still get that fixed over the next 6 months so that you aren't worried about tax season this next year. So just to start with, just want to ask a basic question. Did you owe more on your tax return than you expected to last year? Or did you get less back than you had hoped for? If so, why? Have you taken the time to think about that? And hopefully you have, and you've corrected the problem. But that's why we're having this video right now. Is so often people don't think about it. You know, they do the same thing and then wonder why it didn't change. So today we're going to talk about some things and maybe some things you haven't thought about, as well as just some basic housekeeping. So first of all, if you did not have the results you hoped for on your 2023 tax return, for starters, if you have withholding done through an employer or you make estimated tax payments, I really don't care how you do it. What I want you to do is just take stock. Have I made any changes? And if you have, or you think you have, this is one of the things I hear all the time. Well, I told my HR department to fix this. Well, what I want you to do right now is to go ahead and pull out your pay stubs when the video's over and just take a look at your withholding. Here we are. You're probably going to be watching this here pretty soon, I hope, and just see how much federal withholding was taken out this year. And then compare that to what was done last year. And you could be able to do that year over year. A lot of you can get your pay stubs online, so it's pretty easy. If not, just see how many weeks are left in the year whenever you're watching this. Compare how much is being withheld now to what was withheld on your W-4. It's not hard to do. If your W-4 had, keep it simple, $2,600 withheld last year and you get paid every 2 weeks, you divide that by 26 and you get $100 a pay period. So you can see how we can quickly back into where am I. If the number still is the same, maybe your HR department didn't get it updated, or maybe you forgot to submit it. I really don't care. Something hasn't changed, and we need to go have additional withholding done if you were short. Now, how do you know how much extra you have withheld? If everything else was the same as last year, let's just say last year you owed $1,000, okay? How many pay periods do you have in a year? Or if we're trying to make sure we don't owe anything, how many pay periods do you have left for the rest of the year? Divide 1,000 by that, and that's how much you need to have them hold additional. It really is that simple to go ahead and get this fixed. Now, if you want to get more specific, the IRS has a wonderful tool. It's called the W-4 Estimator. And I've talked about this before in other videos. If you actually were to contact me and ask me to help you calculate your W-4, I'm going to be honest with you. I'm going to go to irs.gov, look up the estimator, and I'm going to put in your pay stub information there because it does a really nice job. And then, of course, when I'm done, I'm going to compare that to what happened on the tax return to make sure the results make sense. So it's possible maybe you put something in wrong. But that's what I would do. The W-4 Estimator is a wonderful tool. It's something you use any time of year. Take your pay stub, if you're married, take yours and your spouse's pay stub, plug them both into that W-4 Estimator, and it's going to tell you, am I on track? And if you're not on track, how much you need to do. So hopefully all of you guys are listening to what I just said, and next tax season, we're not going to have an issue. But I know we will because it happens every year. But please listen to me. This can make your life very, very, well, you can make it a lot better. But let's move on to some other things that cause this to happen. Why does it happen? Well, quite often, one of the biggest things I see is we have two working spouses. And so what happens is you fill out your W-4 and you say, I'm married, one job, and zero, or kids or whatever. Then what happens is your HR department uses the IRS tax tables, and they say, all right, based on this income, this is how much tax he's going to owe or she's going to owe. Well, the problem is your spouse has already blown through all those first tax brackets, but your other spouse doesn't, your other company that their spouse is working for doesn't know that. And so you're both starting off as if you're in the 0% tax bracket, and you're not. Your spouse may already have you starting in the 15%, well, 12% or 22%, whatever, it doesn't matter from year to year. But that's what's happening. They've already blown through all those brackets, and now you're up here. That's why so often with married couples, they end up short. And there's a page 2 to the W-4 that nobody ever looks at that is designed to handle just that. But if you find page 2 too difficult, once again, the IRS's website for the W-4 estimator is awesome. It will help you get that resolved. But so often people don't know why, and so I want to go ahead and explain that to you. The other thing that happens is maybe you decide you love the discounts you get when you work at Kohl's. So you get a part-time job at Kohl's, get the discounts, it's wonderful. You only made $6,000 or $8,000, but then all of a sudden your tax return got hammered. Well, once again, you were in a 24% tax bracket, you made that money. Well, Kohl's only knows you made $6,000, so they don't hold out anything, because if that's all you made, you don't even cover the standard deduction. You don't need to hold anything out. Problem is, you're already at that 22, 24, 12, whatever, and so you're gonna owe tax on all that. So once again, same scenario there, use the W-4 estimator to cover that. Because otherwise, unless you're holding out a bunch extra at your primary job, you're going to be short. And I see this every single year. Okay, what's some other things that can cause this to happen? Well, one of the things, probably the most common I see after that, is retirement distributions. So many times, because you go get that money out of your 401k, your IRA, you make an early distribution because you're below 59 and a half, and your investment advisor may tell you, they may not. I always hear they don't, but I don't know if that's true. But they always say, nobody told me. But either way, they hold out the taxes. Well, how much gets held out most of the time? 10% for federal, nothing for state. Well, guess what? If you're below 59 and a half, there's a 10% penalty. So right away, what was withheld only covered the penalty. Refer back to what we were talking about earlier. All your income was stacked on top of that W-2. So you just got that distribution for $50,000 or $20,000 or $10,000, whatever. And all you covered was the penalty. But if you're in a 20% bracket, plus state, don't forget about state that you forgot about, which is another 5%, an additional 25% tax is owed, and you did not hold that out. It happens every single year. It makes me so frustrated. I hate making that call, but nothing I can do about it. But if you know this up front, and that's why I think it's so important for me to talk to you about this in the middle of the year. If you've already done that, well, you can at least start setting money aside because you already messed up, but start setting it aside before you spend it all so that when we do the taxes next year, you're ready. If you haven't done it yet, make sure we at least hold out whatever your tax bracket is, plus the 10% penalty unless you're over 59 and a half. And don't forget the 5% state. See it all the time. And unfortunately, it happens so often because we drew that out because we were in a difficult situation. Maybe we'd lost our job. Maybe a transmission blew up in our car. Maybe we needed a roof, whatever it is. And so we took it out and we spent it all. And now it's tax time. We don't have the money to pay the taxes. So now what do we got to do? We got to go take another distribution so we can pay the taxes. And it's a vicious cycle. So please take heed to this. If you're going to take money out, please ask your advisor to look at your tax bracket and make sure you're holding enough out, because this one rears its head every single year. Okay, next, new jobs. One of the things so many people aren't aware of is the W-4s changed a few years back. And those of us who are older, we remember when you would fill it out single 0 or married with 3 dependents or whatever your situation was. And we understand that system. It made sense. Now they changed the W-4s, and at this point, pretty much all employers are using the new ones, or they should be. And they don't calculate the same way. There is no add 4 dependents. It's a different calculation. So I'm going to refer back to what I said at the beginning. If you start a new job, go ahead and go through the W-4 estimator, but use it as a second job. So if you had one job and you just switched jobs, fill it out as if you had 2 jobs. And we want to put in the old job as 1, and then the new job, what we expect to make, is 2. That way we get the right number. If you don't, exact same scenario. Once again, we're stacked on top of each other, and we didn't hold out enough taxes, and tax season is not going to be fun. And so I want you guys to be prepared. Okay, one last thing. I'm going to talk about this one because I had a feeling this was going to go into 2 parts, and it did. So the next one I want to talk about is if we inherited some money. And so often we don't think about that. And we take the money, and then tax time comes, and all of a sudden you had a tax debt, but you've already spent it all. So this is a complicated video, and we may have to make another one on it just to kind of cover it. So to keep it simple, if you've inherited money, it would probably make sense to talk to your tax advisor, which if you're watching this, maybe me. If not, talk to them to make sure there aren't any surprises. A lot of inheritances are free as far as tax-wise to you. Life insurance, generally not taxable, but the interest income that it generates is. But when you start getting inherited IRAs, that's another video because the rules just changed on that, and I'll try to cover that in the next few weeks. But brand new rules on that. Not time for that here. Maybe you inherited a house. When did you get it? There's a lot here, probably a whole other video. So just to keep it simple, if you got some type of inheritance, don't try to guess. Go ahead and schedule an appointment. It's going to be worth the hourly fee to go sit with an advisor to make sure that you're okay. Because I know so often what happens, we get a little bit, it's fun, we go buy a new car, a boat, a motorcycle, remodel the bathroom, whatever it is you want to do with it, and then tax time comes and it's all gone. So hopefully this has been helpful. Our next section is going to be on things that are a little more complex. So come back for that one. Down below, go ahead and add any other questions you might think that we should cover, or topics, or even questions related to this video. I'll do my best to answer those. Don't forget to subscribe. That way you'll get the ding and know when the next video comes out, because my goal here is to help you guys. So thanks again, and we'll see you next time.